The market is trapped. Simple as that. It's caught between some incredibly powerful bullish tailwinds and, on the other side, some severe geopolitical headwinds. This is a standoff. So what we're going to do is provide a tactical framework for navigating all this volatility.
And this really boils down to the single most important question for every trader out there right now. Is this a bull trap or is this a generational buying opportunity? The answer? Well, it's going to be determined by which one of these forces we're about to break down wins the coming battle. The stakes could not be higher.
So the first critical piece of data we have to look at is the VIX, the market's fear gauge. It is holding firm, right above that key support level of 20. Now what this tells you is that despite any calm you might see on the surface, the options market is pricing in significant underlying risk. It's directly linked to the geopolitical stuff we're about to cover. Make no mistake, this is not a complacent market.
And that brings us right to the core tension. You can think of the market as a coiled spring, just wound tighter and tighter by two completely opposing sets of drivers. So let's break down each side of this tug of war. The power on both sides here is just immense. I mean, look at the left. You've got some serious bullish pressure. Retail traders are buying the dip with a ton of conviction. We're talking the fifth largest inflow since 2008. The Fed is basically telling you rate cuts are coming, and we're heading into a historically strong fourth quarter. But then you look at the right. The fear is real. U.S.-China trade talk is at a fever pitch. A sovereign debt crisis is a legitimate threat. And the government shutdown means we're all flying a bit blind on key economic data.
Okay, let's drill down into the immediate catalysts. That November 1st tariff deadline, that's the single biggest known event risk on the calendar. At the exact same time, you have a Fed governor openly calling for an aggressive 50 basis point cut, which just confirms the Fed's dovish pivot. Then you have the shutdown, which adds this whole other layer of uncertainty, and it makes corporate earnings, like the upcoming report from TSM, even more critical for setting the market's direction.
This timeline really shows you exactly how we got here. See, this conflict isn't new, but it is absolutely escalating. The failure of that Phase 1 deal has led directly to this November 1st deadline. And in response, China is threatening to weaponize its control over rare earth minerals. This is not just talk anymore. This is brinksmanship, and it has serious supply chain implications.
Okay, so now let's get tactical. Let's move to the dashboard. All this analysis is pretty useless without actual price levels. These are the lines in the sand. These are what will define who is in control, the bulls or the bears.
All right, this is your entire framework on one slide. Now let's be crystal clear. These are not predictions. They are triggers. For the S&P 500, a break below 65.47 signals the bears are taking over. A hold above 6,700, which, by the way, is a major options gamma level where dealer hedging can just pour fuel on the fire, that confirms the bulls are in control. For semiconductors, our market barometer, below 330 is your bearish signal, above 348 is bullish. And as for the VIX, as long as it holds above 20, risk is high. A break below 19.30 would signal a real return to calm. You need to watch these levels.
Now, before we explore how this could play out, we have to go through the compliance disclosure. This is mandatory. This is educational content only. It is not financial advice. All markets involve risk, and that includes the potential loss of your principal. Options are particularly risky. You must always do your own research.
Okay, with that framework in place, let's build out the first primary scenario. What does the world look like if the bulls actually win this fight? Well, it's a path that's really paved with de-escalation and a very friendly Fed.
So the bull case really kicks off with one single catalyst. The US and China step back from the edge and announce a tariff truce. That one move removes the biggest headwind we have. Confirmation would then come from strong TSM earnings, which would lift that all-important semi-sector. From there, the market is totally free to focus on the good stuff, Fed rate cuts and that powerful Q4 seasonality. But there is a very clear kill switch here. Any official word of retaliation from China on rare earths would immediately, and I mean immediately, invalidate this bullish thesis.
Now, let's look at the other side of the coin. The bear case is just as plausible, and it gets triggered by an escalation of these exact same geopolitical risks.
The bear case really ignites if China makes good on its threat and announces those export controls. Confirmation follows when the US goes ahead and implements the new tariffs on November 1st. This geopolitical shock then connects directly back to our technical dashboard. The driver for a really sharp move down would be the S&P 500 breaking that critical 65.47 support level. If that happens, you can expect algorithmic selling to kick in. The kill switch here is pretty obvious. A surprise, comprehensive trade deal would instantly kill this bearish scenario.
So,
We have two clear, opposing scenarios, and we have the levels that define them. So how do we translate this into a disciplined, risk-managed structure? And I want to be clear, this is for educational purposes.
Look, a professional approach always follows a process. First, you have to identify the primary risk you're positioning for. Are you looking for a breakout or just more chop? Second, and this is the most important part, you define your invalidation level before you ever enter. At what price are you wrong? Third, you select an option structure that fits that thesis with defined risk. And fourth, you manage your size. Start small. Wait for your levels to confirm before you even think about adding to the position.
So, to illustrate these concepts, let's just run through some examples. For a directional breakout of our key levels on SPY, something like a debit spread gives you a way to participate with a capped defined risk. If you believe an asset, say Tesla, it's just going to stay range-bound, a structure like an iron butterfly is literally designed to profit from that consolidation around a specific price. And for a view on a sustained trend, maybe in something like gold, a diagonal spread can be really effective for playing that longer-term move. Again, these are just educational examples of how you align a structure to a thesis.
Which brings us right back to the central question. The market is coiled, the levels are clear, and the scenarios are defined. But stalemates like this are always broken by a catalyst. So the question you should be asking yourself is this: what is the catalyst that no one is watching?
And we'll end with our final disclosure. This is not trading advice. Markets are unpredictable. There are no guarantees. You must always trade your own plan, manage your downside risk, and independently verify all information. Stay disciplined.